You hear all these people talking about trading this, buy this, sell this, but how do they actually make money? Well, in this video, I'm about to talk about the ins and outs of trading, as well as technical analysis and what to look out for so that you could use this and improve your day-to-day trading routine. First things first, what are we actually looking at? So we look at charts. Most traders, including myself, look at Japanese candlesticks. There are different types of charts you can do, like line charts and things like that, but personally, I prefer to look at Japanese candlesticks. We look at these charts to try and predict and analyze to see what price is going to do next. We will go through the different types of analysis that we use to do this later on in the video. We're literally just staring at the charts trying to see, are we going to go up or are we going to go down, and when is the right time to take an entry? There are two types of analysis. You've got fundamental analysis and you've got technical analysis. Fundamental analysis is to do with the news. So you look at the news and see, how is this news going to impact price and the direction of where it heads to? For example, CPI, is it going to go up? Is it going to go down? Is it going to have a massive wick? The impact of the news. However, technical analysis is what I focus on more, solely because I believe news follows the technical analysis anyways. I prefer technical analysis because you can analyze the spot patterns on the market that it has previously done, and it helps you to predict what it will do in the future. There are also traders that wait specifically for high impact news. So they will literally full port their account just to see, are we going to go up or are we going to go down? I personally wouldn't recommend that, but some traders do risk their whole account on high impact news. A lot of traders like to do both, so they can implement both the news, fundamental and technical analysis in one. What you would do then is basically, there's this thing called Forex Factory, and it's not sponsored or anything like that, but I used to use this as well when I used to trade news. It tells you all the news that's coming up in the week. You can scroll months, you can scroll the day, you can pick however you want it. It shows you high impact, medium impact, and low impact news. So for example, if there's a bank holiday, it literally says bank holiday. So usually there's less volatility then, or if there's a high impact, it shows you what it was previously. It's just actually a really useful website to show you the news. You can kind of get familiar with it that way. When it comes to technical analysis, the first thing that you need to do is identify the trend. And how you do that is find your high highs and higher lows for a bullish market, and lower lows and lower highs for a bearish market. Identifying the trend is the very first thing you need to do. Without identifying the trend, how are you meant to know if it's going to go up or down? The way that I like to trade is identify the trend, find a key area of interest, and then wait for price to reach that area in order to have a reaction, and then we either look for buys or sells. But before we even get to that stage, we need to trade with the trend, especially as a beginner. The trend is your friend, and I know you probably hear it a lot, but it's true. You can take counter trend trades, of course you can. I take them too, but I try to stay away because the high probability setups are you simply trade with the trend. How do you identify the trend? Okay, so you find yourself a high and a low and wait to see if price breaks either above or below your high and low, to then see if you create a higher high or a lower low. Say price breaks above, you then have a higher high, which means that you need to find your higher low. The opposite is true when price breaks below your low, creating a lower low, so then you also need to find your lower high. I will do a full video breaking this down and how to identify the trend and market structure. That's the basic of it. A bullish market has higher highs and higher lows, which means bullish equals buys and bearish equals sell, because we have lower lows and lower highs. Then once you have your trend, we need to find our area of interest, and an area of interest can either be a support and resistance level. So for example, picture support as a floor. We all walk on the floor, that's our support. If you're downstairs, you're in the living room, and you suddenly think, oh, I want to go upstairs, watch some TV in my bedroom. So you use the stairs and then you start walking on the floor upstairs, right? But that floor upstairs was previously your ceiling when you were in the living room. If you want to go back down, you're walking on the floor, you use the stairs again, and then you're back in the living room, you look up and you have the ceiling above you. That ceiling that is above you used to be your floor that you're walking on. So that is basically what support and resistance is. Support is there for price to bounce off of, look for buys, and then resistance is basically like a ceiling restricting price to go higher. Support can turn into resistance and resistance can turn into support, but don't worry about that just yet. Just know that support is like a floor, resistance is like a ceiling. Once you see price reach your support, we are then looking for buys. Obviously not straight away, we need a bunch of other things to happen first. Support is there for price to bounce off of and go up. Therefore, if you reach an area of support, we are most likely looking for buys. The opposite is true with resistance. Resistance is there like a ceiling, blocking price from going higher. Once price reaches a resistance, most times we are looking for sells. Obviously, as soon as it reaches a support or as soon as it reaches a resistance, we don't click buy, sell. There's other confluences and other things we do need to wait for. The basics of it. Support equals buys, resistance equals sells. Quick recap, obviously, identify the trend, find our area of interest, which is our support or resistance zone, and then wait for price to reach that zone and have a reaction. Going back to the candlesticks, there are different types of candlestick patterns, things that go on that you can use and read in order to help you understand what price is going to do. For example, you have bullish candles and bearish candles. There is a pattern called the head and shoulder pattern. This pattern is a reversal pattern, so it happens either at the top of a bullish trend or at the bottom of a bearish trend, which if it is at the bottom, it is an inverse head and shoulders, which is exactly the same, it's just upside down. You can use that pattern to identify that price is done going up or done going down and it's starting to prepare to shift to the other direction, and then you can look for entries that way. Remember, all of these patterns are only confluences. Don't trade them solely. Don't think like, oh my gosh, I see a head and shoulder pattern, I see this, I'm going to enter. And the same with the support and resistance. As soon as you see these things, you don't enter. These are just things to help you in steps along the way to be able to build your strategy up and build your analysis. The head and shoulders pattern has a left shoulder, head, and a right shoulder. Once it has created those things, it has something called a neckline. That neckline can be used as an area of support and resistance, i.e. you wait for price to break below, have a retest, which is retesting the neckline, which means let's say it's the support because it's bouncing off, then it breaks below, it has a pullback, and it is used as resistance. Again, don't worry about support turning into resistance too much, but it's just like a little intro so you are aware for the future. Once price retests the neckline, it is an indication that it is ready to go down. Obviously, you need more confirmations. I cannot stress this enough. Please don't literally, as soon as you see something, don't take it straight away, but it is an indication, one of the indications that price is ready to go down if it does respect that neckline. Same with the inverse head and shoulder, is exactly the same apart from its opposite. When price is going down, which means it's bearish, we have the inverted head and shoulder happen here, so it has the neckline, it is trying to break above, but you have that ceiling, i.e. the resistance, and then price finally breaks above it, decides to have a pullback and retrace, which is then retesting the neckline, also known as the support, and then it's looking to go up. I know it seems a little bit complicated. I promise I'll explain it more in my other videos, but I just want to give you a quick introduction so you are aware of the different things that you can look out for. The break and retest is my personal favorite pattern that happens. I use it all the time. It is seriously so simple. It is literally like, pretend you're downstairs in the living room. You use the stairs and start walking on the ceiling, how I was saying before. That is literally break and retest. That means support turns into resistance and price is ready to go up. For example, you're in the living room, want to use the stairs, start walking on the floor, which is upstairs, which was previously your ceiling downstairs, and you have just done a break and retest in person like price does all the time. So that is a continuation pattern. Basically, it means it's ready to go. As you have your high highs, higher lows, it reacts with the structure points and pushes price to go higher, or the opposite is true. A quick summary, I know I've said a lot of stuff, but remember, this is just a beginner introduction to charts and patterns and things that I'll explain. Everything, I'll do detailed videos on each of these things so you can find out a little bit more. So quick recap, bullish has higher highs, higher lows, and we are looking for buys when we are in a bullish trend. A bearish market means sells going down. We have lower lows and lower highs. After we have obviously identified our trend, bullish or bearish, we then look for our area of interest, such as support and resistance. Remember, support is the floor, resistance is the ceiling. We can then apply the different types of candlestick patterns, such as head and shoulder, inverted head and shoulder, break and retest. There's plenty of others. One of the main simple ones you can use. Don't just enter as soon as you see these things. These are very good extras to add into your analysis. With that being said, I hope you enjoyed the quick introduction to technical analysis for beginners. If you want to find out more and learn my exact trading strategy and jump on the live calls we have on Sunday to break down the pairs with my students, make sure to click the link in bio and join the True Wealth community. If you do have any questions, leave them in the comments below and I will be making more detailed and educational videos for you guys to help you understand trading a little bit better. With all that being said, thank you all for watching. Like, comment and subscribe, and I'll see you guys on the next one.